This podcast is for educational purposes only.
Understanding the option risk with covered calls. Understanding the risks associated with covered calls is important for investors who employ this options trading strategy. Covered calls are a popular options strategy where an investor holds a long position in an asset, such as a stock, and sells a call option on that same asset. Here are some key risks to consider when using covered calls. 1. Limited upside potential. By selling a call option, the investor collects a premium but caps their potential profit on the underlying asset. If the price of the asset rises significantly, the investor's potential gains from holding the asset are limited to the strike price of the call option. 2. Obligation to sell. When selling a call option, the investor is obligated to sell the underlying asset at the strike price if the option is exercised. This means that if the price of the asset rises above the strike price, the investor may miss out on potential gains from holding the asset. 3. Market risk. The price of the underlying asset can be volatile, leading to potential losses on the asset itself. While the premium received from selling the call option provides some downside protection, it may not fully offset losses in the value of the asset. 4. Opportunity cost. By selling a call option, the investor gives up the opportunity to benefit from any significant price increases in the underlying asset beyond the strike price of the option. If the asset price rises sharply, the investor may regret capping their potential gains. 5. Assignment risk. There is a risk that the option may be exercised early, especially if the option is in the money. This could result in the investor having to sell the underlying asset earlier than expected. 6. Time decay. Options have an expiration date, and as time passes, the value of the option decreases. If the price of the underlying asset remains relatively stable or decreases, the time decay of the option may erode the premium received from selling the call. It's important for investors to carefully consider these risks and understand how they may impact their overall investment strategy when using covered calls. It's also advisable to consult with a financial advisor or options trading expert before engaging in options trading strategies. Thank you.